For generations, the whole American dream was pretty much built on one thing: owning your own home. It was seen as the undisputed path to building wealth. But lately, a lot of smart investors are starting to ask a really tough question. Has that dream become less of a solid foundation and, well, more of a financial trap? And that quote, it perfectly frames how we're going to look at this. We're going to stop thinking about a home as just, a place to live and start analyzing it for what it really is from a financial perspective, a major private equity deal. So that really brings us to the big question, right? In today's market, with interest rates high and prices even higher, is buying a house still a smart investment, or could it actually be a financial trap disguised as a dream? Let's break it all down. All right, first up, let's dive into the most powerful and maybe the most dangerous tool in the entire real estate game: leverage. It's the thing that can absolutely supercharge your returns. But, and this is a big but, it can blow up your losses just as easily. Okay, so the concept itself is pretty simple, right? You put down a small piece of the cost, let's say 20%, and the bank comes in with the other 80%. What this means is you get to benefit from any price increase on the home's entire value, not just the little bit of cash you put in. When the market's going up, it honestly feels like magic. But here's the catch, and it's a huge one. Leverage is a total double-edged sword. It's fantastic at amplifying your gains when prices are rising, but it does the exact same thing, but in reverse, to your losses if prices stall out or, even worse, start to fall. All of a sudden, that big loan from the bank isn't your friend anymore. It becomes this massive weight dragging down your initial investment. But here's the kicker. The cost to get that leverage has just exploded. Just look at the difference here in the monthly payment on the exact same $500,000 loan. A few years back, at a 3% rate, you were paying less than $1,700. Today, at 7.5%, that same loan costs almost $3,500 a month. Think about that. That is over $1,800 just gone every single month. That's cash that isn't building you any equity, and it's cash that you can't use to invest in anything else that might actually give you a better return. And you know what? That mortgage payment, that's just the tip of the iceberg. The real financial drain, the part that catches so many people by surprise, comes from all the unseen costs, these constant little financial leaks that most buyers just completely underestimate. See, your mortgage, that's predictable. You know what's coming. But these costs, not so much. You've got property taxes, which can go up. You have homeowners insurance, which is soaring in a lot of places. Then there's the surprise repairs, maybe some HOA fees, and of course, all the utilities. These aren't just little expenses. They are major ongoing costs that come with ownership. And get this, most financial experts say you should budget between 1% and 3% of your home's value every single year, just for maintenance and repairs. So on, say, a $700,000 house, that could be $21,000 a year. That right there is the silent killer of your investment returns. All right, so we've talked about the costs. Now let's really put on our investor hat and analyze this thing like a true deal, looking at things like liquidity, transaction costs, and the most important part, the actual returns. Think about it. You can sell a stock in, seconds? A house is the complete opposite. It's profoundly illiquid. It can take months and months to sell, which means your capital, often hundreds of thousands of dollars, is totally trapped. You can't get to it in an emergency, and you can't pull it out to jump on a better investment opportunity without going through a long, expensive process. And speaking of expensive, between all the closing costs when you buy and the realtor commissions when you sell, you could easily spend a massive $50,000 to $80,000 in fees on a $700,000 home. That is a gigantic financial hole you have to dig yourself out of before you even see $1 of profit. So this leads us to the ultimate investor question. Really, the question you should be asking about every financial decision. What's the opportunity cost? Every single dollar you have tied up in a down payment, in mortgage interest, in property taxes, in repairs, that's a dollar that can't be working for you somewhere else. And wow, this chart right here, it just lays that opportunity cost out perfectly. When you look at history, after you subtract all those carrying costs and transaction fees, the actual net return on a primary home is, well, it's pretty modest. Now compare that to the average historical return of a simple S&P 500 index fund. The difference in how much wealth you could build over decades is just staggering. Now let's talk risk. Seriously, no financial advisor on the planet would ever tell you to put 70% of your entire net worth into a single, illiquid, highly leveraged asset that's completely tied to the fortunes of one zip code. And yet, for a huge number of homeowners, that's exactly what their personal balance sheet looks like. It is the textbook definition of concentration risk. Okay, so after all of that, what's the big takeaway here? What do you actually do with this information? Well, it's not about just avoiding homeownership forever. It's about learning how to make a much smarter, more strategic decision. And I want to be crystal clear about this. The point isn't to say you should never buy a house. It's about giving you the tools to approach the decision with a cold, rational, data-driven mindset, just like you would with any other major investment. The key is not to let emotion or what everyone else is doing cloud your financial judgment. So here's a simple, actionable framework you can use, an investor's checklist, if you will. First, calculate the true total cost of owning the home and make sure you include that 1 to 3% for maintenance. Second, get a real estimate of your total transaction costs for both buying and eventually selling. Third, do the math on your opportunity cost. What could that money be earning somewhere else? And finally, number 4, be honest about whether this decision really fits with your personal and professional goals for the next 5 or 10 years. And that's really the question we want to leave you with, something to think about as you run your own numbers. The goal of any good investor is to make their capital work as hard for them as it possibly can to build wealth. It's time we all start applying that same tough mindset to the roof over our heads. Is it truly your best investment, or is there a better job out there for your money?